Hello, everyone. Welcome to another edition of Tip Tuesday. Jeffrey Nance here with you. Sorry for a little bit of a late start. I was a little confused because I've got two different topics, and so I was a little confused as to which one we were set to cover today, and trying to make sure I was covering the right one here. Now, both of these topics would be good, um, but I was trying to make sure I did the one that I was supposed to. So um, this one is titled "Overcoming Fear and Greed," but what we had talked about in our week events was that we would talk about proper buy and sell points, like target prices, knowing when to stop out and stuff. And so, how to set realistic profit targets and stop loss levels is what I had received. And that's what I had planned to teach. So I think that's what I will teach. I mean, certainly we could do the fear and greed thing, but we may need to put that off till next week. I do think that there are a few things this week in particular that can really help us hone in on this idea of setting a realistic price target. So, when you enter any trade, it's important that you kind of have an idea where you think the stock is going to go and why. And from time to time, when we're doing live trading or something like that, somebody will say, well, um, I think this stock is going to go to like $60 and it's at like, 40 or 50 or something. Like, oof. Well, there are several hurdles along the way. Let's look at this price. Let's look at this price. Let's look at this price. And it's not that it can't get to where you think it's going, but what is your time horizon? So is this a realistic thing for this to happen? Are we talking this week? Are we talking within the next 2 weeks? Or are you going to try to hold this thing for like several months? So we have to be on the same page there. Since most of our trades, right, if you're doing the tradeway system, are going to be lasting anywhere from 2 days to 2 weeks normally. Okay. Now, again, guys, some could be day trades, some could last longer, but for the most part, most of your trades are going to work within a couple of days, certainly within a couple of weeks. And unless you're doing a very specific type of trade, you really shouldn't be going out past 2 weeks where you wouldn't have had some opportunity or multiple opportunities to go ahead and take profit on that position. Now, if it's just working amazingly well and you're like, I can't figure out a time to get out, uh, maybe it does go longer, but for the most part, 2 days to 2 weeks. So when it comes to that, what does that look like in a very real setting? So what I thought I would do for you guys today is just show you some stuff that we did actually this week. So I was teaching an event in San Francisco, technically. Now, it was for the San Jose market, but we were meeting in San Francisco. And so those guys drove out there from all over that area to come and meet us. And we entered two trades this week on Friday. So we got in on Friday. Hope all you guys can see this well on your screens. I'm gonna zoom in even a little bit more because I just want to hone in on what's happening here. And so when you're looking at this trade, the first thing that we would want you to do is say, okay, what is realistic? So when it comes to a profit target and stops, I'll show you the actual order that we had on this trade here in just a second. But let me walk you through the process. So this is a very, very, very particular type of trade. And I told those guys, I said, it's highly likely to work this week. So this is the kind of trade that you may not know what the pattern is, but it is predictable, repeatable, and reliable. I told them it probably works 70 to 80% of the time. I think we used 70% this weekend. And I said, so let's go and let's do it. So let's go out there, and we bought this stock. And I believe we bought it around 14.10. Now, you can see that on this day right here, the high was 14.41. And we caught it as it was kind of coming back down. So, it closed at 13 or 14.01. And so I believe we bought it at 14.10. So we were down about 9 cents a share. And I told them to not freak out. It was, for a lot of them, it's your first paper trade. I was like, don't freak out. It's okay. Let's let the process play out. Let's see what happens here. And so we talked about this. We're going to stop out, and we looked at the low. And that was 13.34. We said, do we really want it to get that low again, or do we want to stop out a little bit higher? I said, there's no need for us to take a bigger expense. Let's go ahead and stop out sooner. So you'll see here in a little bit, we had our stop loss pretty close. Now, some of you guys have been to step one, and you said, Jeffrey, you guys said 8%. Well, I don't use percentages. Okay, I use lines, I use EMAs. And I would encourage you guys to do the same thing. 8% is kind of one of those things where you just throw it out there and say, if you got nothing else, better to lose 8% than 10 or 20 or 50, right? So, but I told those guys, I said, that just because you can lose 8% doesn't mean you should. It doesn't mean you want to. So don't just get in your mind, I've got to lose 8% before I stop out. You can stop out much sooner than that if the trade isn't going to work. And so what we said is we're going to try to ride this thing back up here to the 5-day. And so on that particular day, the 5-day was at 15.26, but I reminded them that it's coming down. So we're actually going to set our profit target a little bit lower. Now, I'm using this as an example. It's a little bit harder, but because we just did it, I want you to see the thought process. So it's very new. It's something we just did this week. So I think it's very pertinent for what you're doing. So you have to understand, if I'm setting a stop loss, all right, there's one. Where's my entry? Well, we talked about that. Now, where's my target? A realistic target is for this thing to go up here into this range. So what we did is we basically said, guys, it should probably get to the 1490s. So let's set our target at 1490. So what I want to do now, guys, I'm going to take you guys over here to our order status. And I'm going to go back to last week and let you guys see the order that we put in here. Now, this is ARRY, and you can see that we bought 100 shares of ARRY at 14.10. Then we set an order. I'm going to go back to the order ticket here. The order status here. And we're going to look at today. And you're going to see that two things have happened. We sold 100 shares of ARRY. So what you're looking for is, where was it executed? It was executed. So we had a limit order to sell at $14.95 or higher. Okay. So we had an order to sell at $14.95 or higher. And it sold at $14.95. So that's the order we put in. We had an OCO, or bracket order, where we had our stop out at $13.75, and we had a sell order at $14.95. So we just said, look, we're going to set it and forget it this week. It's either going to stop us out at $13.75, or it's going to go up to $14.95 or higher, but we're going to stop out there. Okay. So let's go and see that this is indeed what happened today. And what you're going to see here is, this was Monday. So we got a decent move up Monday. We got a pretty good move up today, right? We got a pretty good move up today. In fact, it actually moved all the way up to a high of 15.13. Now, notice it sold us at $14.95, but it opened this morning at $14.48. Okay. Climbed up to $15.13. And guys, I did nothing for this to happen. Nothing. Okay. We just set an order, and we set it and forget it, because we could do that bracketed order there. The OCO, one cancels the other. We put in that order, and this morning that executed automatically for me. So I sold out of this trade at $14.95. You can see it's at $14.90 now. So I sold about 5 cents higher than it is. So you can see how it came up there. It hit the 5-day. And to some extent, it is pulling back a little bit from the high already today, with the market way up really, really, really big today. All right. I'm just going to go check the comments, make sure there is anything. Okay, cool. All right. So now let me go back and show you the other trade that we did. I'm actually going to show you a couple of these today. ESI. Uh-oh. Okay. Okay. Well, I'll show you what happened with ESI. So this one's a little bit tougher. So the 10th was Friday. So we entered this trade. It closed at 1927. I'm trying to remember where we got in. Let's see if I can go find that real quick. So we entered this trade at ESI. We entered at 1922. Now we set a fairly short target here, because what we said is we may not make a lot on this trade because we're just going to go up to the previous highs. And what you guys can see here, and this is really important for our discussion today, if I'm looking at a trade like this, where is a realistic target? The previous highs are a great place for you to start. So what you want to do is take your crosshairs, go over here, and then you're going to look up here at the top, right? So look up here where it says H. This is open, high, low, close. Look at the highs. All right, so we're on this candlestick. The high is 1950. What about this day? The high is 1949. What about that day? The high is 1949. So we put in an order, a limit order to sell at 1940, I think 8. Okay, just a little bit lower just in case it went to 1949. We wanted to make sure that we captured that. Now, what's the downside of setting an order like this? Well, what if you get something, like yesterday, moved up to 1939. We got really close to our stop out. And then what happened today? Well, today it gapped up and it blew through it. Okay, so what happened to our order today? So we had an order to sell at 1948 or higher. Let's see what actually happened with our trade today. Okay, they sold ARRY, all right, or ESI. They sold ESI here. Let's go to today. They sold ESI at 1963. That's a bit of a bummer. Let me tell you this too, guys. Normally that would not have happened. So let me tell you what would have happened. Sometimes the paper trading accounts get messed up, but this stock opened today. Well, no, it would have. See what happened here? It opened at 1966. So we had an order, and that was the low, by the way, 1968. So we had an order to sell at 1948 or higher. Well, let's see what it did to us. So what did it do? Okay. It executed at 1963. Now, 1963 is a little low, right? 1963 is a little low, but it was well above our 1949 target. Why did it do that? Because our limit order is to sell at 1948 or higher. Well, since this gapped up to 1966, that's higher. They sold us a little low there, 1963. So the bid-ask spread was a little wider than normally it would be. But still, we got the benefit of that. Now you say, Jeffrey, wouldn't you have rather sold at like $20? I sure would have, but that's not the order I put in. I wasn't anticipating it was going to gap up and flow through that. So we still did well. We still made more than we anticipated on this trade. But if you do set the automated orders, all right, and you do get a gap, then it can, move up higher than you think, and it might be an automated order to sell a little bit earlier than you would have liked. Because again, if we were still in this trade right now, we sold at 1963. We could have sold right now for $20. And obviously we would rather do that, but we set that order up, that bracket order, that our target was right here. We exceeded our target. If we had not set the automated order, then we would, of course, stayed in this trade and we would wait until it, goes up even higher. And what we would do from here is start to look to the left and say, well, what's next? Okay, well, 2013 seems realistic. It was the low from right here. Let's zoom out a little bit more. See if there's anything else up here that we might recognize. That's a strong area right there. We have multiple wicks at the same price point, 2037. Look at that. We also get a low right there, 2037. So that's also a realistic price target at this point. So if we were still in it, we would be waiting for this thing to go up a little bit higher. So again, it exceeded our expectations, but that was a realistic price target based on the data that we had and the expectation that we had this week that the market would generally float up. I was certainly not anticipating the blow up that we've had this week when the market just responded like extremely positively to the consumer price index report. All right, one last one. I hope this is helpful, but this is going to be Tesla. And I talked to students about this, and this is a pretty cool thing here. So we looked at Tesla, and the student asked me on this day, they said, you know, where do you think Tesla's going to go? And guys, here's a really important thing. Gap lines matter. And when a stock gaps, you see the gap down after earnings, that line really matters. Well, how do we know that it matters? Well, look at that. After it gapped down, it made its way back up, but then as soon as it hit that line, it slammed on the brakes. So what I said to her is, well, your expectation is that this stock is going to move from 214 up to 226, 214 to 226. See, so we're using information available to us, a strong gap line. That's our target. That's a realistic target. Guys, look at what it did yesterday. I mean, this is really pretty crazy, right? Pretty cool. So we targeted 226, but we were really just kind of saying, well, let's see what happens when it hits that line. That was our target, when it hits that line. Well, look at that wick yesterday. So not only did it go up to basically our target price, but it did it in almost a day. Now you might be thinking, well, what did it do with the gap today? Well, it blew up. Again, blew up higher than we thought. And in fact, it's even past the 50-day, but they're actually selling today, and they're actually selling. But it was up $9. But see, outside of a blow up like we had, it was realistic. Okay. And again, what we're talking about today, how do we set realistic profit targets and stop outs? You know, so a realistic stop out would be right here at that previous low. Okay. A 203, and a realistic price target is the previous high. If you were to do something like this, you can go back to Apple from earlier this year. Not Apple now. It's a little trickier, but Apple earlier in the year. Okay. And guys, look at this. I'm gonna zoom out a little bit further here. But Apple stayed in its uptrending range for basically from February to August. So until that earnings report knocked it out, it stayed, even in the midst of an earnings report, it stayed in its range. March, April, May, June, July, and then hopped out in August there. But 5 months, this stock stayed in its range. Well, if you can draw good lines, good diagonal lines like this, it'll give you an idea of where you bought and when you ought to sell. See, your buy point is here. You stop out below support, and your target is your line. Okay. Over here, you're buying EMAs, but your target is still the same. Your target is that line. Unless, and one of the things that you'll hear me say from time to time is target the previous high. Because if the stock is going to go up, it ought to get to the previous high. If it goes past that, then you say, okay, well, then it's headed up to a diagonal line. But don't just assume it'll get to the diagonal line until it exceeds the previous high. You can see over here that it did that, but over here it didn't. It just got to the previous high, and then it fell from there. So those are good targets. If you're looking at a move down, you say, I'm buying a put. Well, again, you're looking for a line or a previous low. So over here, once we drew that line, if we got into a put right here, we were anticipating we wouldn't have had all this data, remember? All right, so we would have been up to here is when we would have started right there. And we would have said, okay, I'm entering a put. Where might this thing go? We would have had that low, that low. We would have said, well, it should go down here. And guys, look at that. Tag that line. And that's when we should be getting out right before earnings anyway. So that's how you set realistic price targets. Look for lines. Obviously, if you have them, look for EMAs. They really matter. Obviously, gap lines are huge. And then diagonal lines, if you have them. Rolling stock, obviously, that would be your target. But try to set realistic price targets within a realistic time frame. And you can see that we were looking at all those things in each of these trades. So a realistic target in a realistic time frame. And that's how you want to make your trades. And when it comes to stopping out, you want to stop out as low as you possibly can. So again, you can lose more, but just because you can lose more doesn't mean that you should. We want you to lose as little as possible. All right, I see Karen has a question. We'll do this real quick, Karen. IRM. Don't know anything about this, so I have no clue what it's doing. Let's go look and see. All right, so let's zoom in here. We're out pretty far. So this gapped up today. And again, if we were just to look at this, we'd say, well, where is it likely to go? Let's look at our previous highs. And we're going to be targeting about 62.30. That is, you can see back over here to the left, there's a lot of stuff happening around that 62.30, 62.40 area. That's a realistic price target. So if the S&P continues to climb, now keep in mind, the S&P is getting closer to what we think could be resistance. So this stock may not get all the way there because, you know, the S&P might flip it around. But for where it is right now, if you were to say, all right, I'm going to go put a target on this, it'd be about 62.30, or maybe a little bit lower than that, but that would be your expectation. So if the S&P continue to float the rest of this week, this stock had an opportunity just to kind of keep floating up. 62.30 would be your target on that. Would be a pretty strong area to consider selling that thing if you're already in it. All right. Well, guys, thanks for being on with us for another edition of Tip Tuesday. Again, this is Jeffrey Nance. Appreciate you guys joining us for today's topic, and look forward to seeing you next time.